In this video, we're going to talk about exchange-traded funds and how they work. Now, in order to provide a comparison, we're going to do a quick review of the concept of mutual funds, which we've covered in previous videos. But this is going to be very brief just to get you a little bit up to speed. So if you remember from last time, mutual fund, there are a couple of parties involved, right? The first, we have, of course, investors, who are the individuals that want to grow their money. And then we have the mutual fund itself, which is the investment. It's the vehicle that investors are going to want to use to grow their money. And on top of that, we have who we call the fund manager, who is the individual who manages the investment. And the fund manager is the person who is going to determine which assets or investments to hold into the mutual fund. And so from investors purchasing this mutual fund, we can get broad exposure to all of these different assets, whichever they are. That's the basic concept here. There are a couple of negative things associated with mutual funds. The first off is we have this fund manager here. Now, originally, this can be a positive thing, but because mutual funds are generally actively managed, which means there's buying and selling taking place, that increases what we call an expense ratio. The expense ratio is the percentage of your total holdings that you pay every year as a commission sort of for the fund manager. It's sort of compensating them for their time and that sort of thing. So because of that, mutual fund expense ratios can be pretty high, anywhere from 1 to 2%. So there's been this increased, let's say, transition or resurgence of passively traded funds or passive income type funds, most notably the actual exchange traded fund. And there's a couple of reasons for that. But the way that exchange traded funds work is they're kind of a blend between two different types of investments. And so they're a blend between stocks and between mutual funds. And they try to leverage the advantages of each one. So stocks being that they can be traded during the day, which means you can log in and you can actually execute a buy or a sell order if you wanted to. With mutual funds, because they use what we call a net asset value, the value of the fund has to be determined upon close of the market. So if you execute a buy or a sell order for a mutual fund at a price, that's not necessarily the price you're going to pay, because they have to calculate, well, what did the assets do during the day? What's the new asset value? And then you pay that price at market close or open the next day. So that can be a little difficult to kind of time markets with mutual funds, because the price that you see isn't what the price you're going to pay. With stocks, with exchange traded funds, they function a lot like stocks, which means it's based upon market conditions and they're constantly fluctuating throughout the day. So it means that you can buy and sell any given time during the day as long as the market is open. The other thing they share characteristics of is mutual funds, because they are diversified. So very similar to mutual funds, exchange-traded funds allow you to get a broad exposure to a variety of different types of asset classes, whether that's stocks, bonds, currencies, commodities, different sectors, different markets, whether it's emerging markets, whether it's developed markets, whatever is the flavor that you're looking for, you can certainly find a mutual fund and an exchange-traded fund or ETF that you are looking for. But there are some differences here. The first notable difference is exchange-traded funds are often indexed. And what that means is they follow a certain index. So there's several common indexes that we see when you turn on the news or you open up the morning paper. You see a couple of indexes that were reported. The most common ones are the Dow Jones Industrial Average, which reports the movements of 30 blue chip stocks. Also the S&P 500, which reports the movements of 500 large cap stocks spread out over a variety of sectors. And you also see the NASDAQ, which stands for the National Association of Securities Dealers Automated Quotation, which primarily specializes in tech stocks, but it has some other holdings as well. But there's like several thousand different companies within the NASDAQ, spread out over a variety of different geographic regions, but they primarily focus on technology. So by looking at these, you can get a kind of a quick gauge on how the markets are performing. Even if you don't know how one individual stock is, you can assume that if the NASDAQ is up, Apple is probably up as well. That's kind of the methodology here. So with index funds, how it works is you have the ETF, And then you have the index fund, or the index itself. And so let's just say, as an example, that we have the S&P 500, which is a very common index fund. So what will happen is this ETF, if it's indexed to the S&P 500, it will mirror the movements of the S&P 500. So the assets that are held in the ETF are identical to the S&P 500, which means that the returns of the ETF are going to be mirroring the S&P 500. So as an example, if the S&P 500 increases in value in a year at 10%, your ETF is also going to go up by 10%. Likewise, if the S&P 500 goes down 3% during the year, your ETF is also going to go down by 3%. So it mirrors the market. So you get that diversification, which is really nice, but it's indexed to the fund. This is important for one main reason. Because it is indexed, we no longer need this guy. We don't need anyone to buy or sell stocks or any other securities that are held in the fund, because the ETF is automatically pegged to that index, whatever it is. And the S&P 500 is one of dozens of different indexes. So this is really good for a lot of incoming investors or people that are new to investing, and really anyone for that matter, because of the fact that it's all automated. And we know that automation reduces costs. So when you're looking at the expense ratio of ETFs, they tend to be a lot lower than mutual funds. You can find indexed ETFs with expense ratios of 0.05%. And I don't mean 5%. I literally mean 0.05%, which essentially means for every $1,000, you're paying 50 cents for that mutual fund. And so this is great for one main reason, and that is because of the fact that if our expense ratio is lower, our overall return has been increased, right? So your overall return is a derivative of the market return less your expense ratio. So there are two ways to increase your overall return, right? One is to, of course, increase your market return, which is largely dependent upon factors that are beyond your control, and also to minimize your expense ratio. And if you can do both of those, you can increase your overall return. So ETFs, for that reason, are very attractive, particularly for beginning investors, simply because of the fact that you don't really have to pay a lot of money as an expense ratio. Thus, you can keep them as far as your return. The other really good benefit of ETFs is they typically don't have minimum purchase requirements. So one of the characteristics of a mutual fund is that you often have to buy in to a certain amount. So many mutual funds will say that you need to buy at least $3,000 worth. And if you don't pay $3,000, or if you don't acquire $3,000 of that mutual fund, then you simply can't buy in, because that's like the minimum buy-in requirement. Every mutual fund's different. Some don't have these, but a lot of them do. Mutual funds are also meant to be more long-term, which means you're supposed to buy them and hold them. That's typically the strategy. ETFs, although I generally recommend more of a buy and hold strategy because they are passive, so you're looking at holding them for a period of time, you technically could buy and sell them relatively quickly, but you are going to pay a trading fee every time you do. And that trading fee can be anywhere from $7 to potentially $10 per trade, depending upon what brokerage platform you use. Now remember, that increases your expenses, which can reduce your overall return. So typically the strategy for ETFs is to purchase ETFs that are indexed to a large, like kind of overall market, like the S&P 500, and then to hold those over a period of time and to engage in transactions very infrequently, which helps you avoid trading fees. So that's a little bit about how ETFs work. ETFs are becoming increasingly popular. I think there's been $4 trillion in assets shifting from mutual funds into ETFs. simply because of those benefits that I described, the low expense ratio, and obviously not having to have a whole lot of financial education to utilize them, to just pick an S&P 500 fund, much like VOO, which is the ticker symbol for a Vanguard S&P 500 fund, if you want to take a look at it to learn a little bit more. So we're seeing these in greater popularity, obviously for the reasons that we talked about, and they're a great on-ramp to get started into investing. Thanks for checking out this video. If you learned something or enjoyed it, please like and share, and of course subscribe so you can get updates on additional content in the future.